Welcome to Taking Stock for the week ending 1st of November 2024, where this week myself, Tim Lincoln, and our Head of Stock Doctor Research, Kien Trinh, streamed you all things share market. How are you, Kien?
Yeah, not too bad, Tim. Last week I was away. I had this trip up towards Adelaide. It was quite a long trip with the family for a wedding, but the kids enjoyed themselves, full of dancing.
Oh, well, good to have you back, mate. But a lot to get through today, being
Mm.
the start of a new month and rolling off October. So we'll do a bit of a summary on that. But before we get started, just a quick and important reminder that all of the information we share today, all of a general nature, and therefore should not be construed as personal advice. And all of the data, performance metrics, and etc. that we share, all historical in nature, and therefore should not be relied upon as a guide for future performance. Well, another month has come and gone, Kian. I can't believe that the year is now rolling into November. Who would have thought that another calendar year could move by so quickly? But it has, and it's been a great one for the market thus far, hasn't it? With the market really roaring ahead globally, and also here in Australia. But October has been a volatile month, or was, sorry, a not volatile month, and in the US last night things really went into the red territory. But the Australian equity market for the month of October declined some 1.3%. So the worst month almost for the entire calendar year. The
Mm.
decline mainly driven by fading optimism around Chinese stimulus measures. Also, obviously, the tensions in the Middle East. We're not quite sure what's going to happen there. Will Iran retaliate after the Israeli strikes a week or so ago? Who knows? We hope not, but the probability of escalation is still high. The US Federal Reserve moving towards a more gradual approach in regard to easing of interest rates. In other words, slowing the pace of interest rates cuts, which is obviously not great for share market sentiment, and concerns around the AI boom following weaker than expected results from AI stocks in the US. And they've really released a lot of their results during the quarterly reporting season over there this week. So
Mm.
that's been very interesting also. Despite this, though, Kien, many of our star growth stocks outperformed the market, and as a collective, they outperformed, courtesy of the recovery from Matter Group and strong performances from Hub24, REA, Net Wealth, and Objective Corporation. On the other hand, October was a weak month for retailers, with Lovisa, Step One, ARB, and Breville sold down on fears of interest rates will remain higher for longer. That over the month, star income stocks underperformed the market due to its overweight exposures to interest rate sensitive stocks within the retail, utility, staples, and REIT sectors. For example, APA Group was sold down after its largest shareholder, UniSuper, sold a 5% stake in the business. Meanwhile, the supermarket chains Woolworths and Coles face regulatory scrutiny and tight household spending, which led to some pressure on their share prices. But we'll cover more on this later in this episode. So, Kien, why have income stocks been impacted so much over the last month, especially when they should be perceived as defensive style equities?
Yeah, Tim, as you highlighted, it all comes down to interest rate expectations and inflation. Although the annual pace of inflation for September quarter slowed to around 2.8%, this was mainly driven by electricity bill rebates and lower fuel prices. The actual core inflation, which removes volatile items like energy prices, actually increased by about 0.8% over the quarter. And that took the annual rate to around 3.5%. And that's still above the RBA's target band of between 2 to 3%. As a result, the market has pushed forward its expectations for interest rates cuts to occur before May instead of April. And the higher for longer interest rate environment is having a negative impact on those retailers, the supermarkets, and also what we call bond proxies like utilities and REITs that tend to have higher debt levels.
Yeah, and with the AGM season in full swing, Kien, there's been a number of surprises, hasn't there? Firstly,
Mm.
let's take a look at Super Retail Group, the owners of Super Cheap Auto, Macpac, Rebel, BCF. Yeah, they're the main brands that they represent. The share price has taken a tumble over the week. What drove the weakness, mate?
Yeah, for the first 16 weeks, Tim, of the financial year, Super Retail reported a 2% rise in same-store sales. And this was softer than expected, with the result also highlighting some margin compression due to discounting and also clearance activity, along with higher costs as well. In addition, you've got their rising loyalty program redemptions, also reducing their gross margins by about 140 basis points. This has led analysts to downgrade their price targets on the stock, Tim, and earnings revisions. Although they remain positive, we expect this to dampen over the next few weeks as well.
Yeah, very interesting, Kien. And given that this is also, or Super Cheap is also a star income stock, do we have confidence in the forecast dividends in FY25, especially with the company committed to funding the rollout of 25 new stores this year?
Yeah, they are spending a bit of money on that, Tim, but the market is anticipating a full year dividend of around 72 cents per share for this financial year, which doesn't appear too aggressive given that the payout ratio is currently around 67%. In addition, you've got the business. They are expected to spend on new store openings and store refurbishments, but there is enough of a margin in free cash flow to help sustain that dividend, as you can see under Golden Rule 3 as well. And the stock is currently on a gross dividend yield of around 7% at the moment.
Yeah, really attractive, isn't it, Kien? Not only from a yield perspective, but also an opportunistic perspective. With share price under pressure, it sort of does start to represent opportunity. But those that are trend sensitive should always take note. And if any of the technical indicators that they use as part of their entry and exit strategies get triggered, then obviously that's an exit. But yeah, looking like a high quality business is representing opportunity from a couple of perspectives. And speaking about the sustainability of dividends, Kien, we've been discussing the merits of holding Spark New Zealand in our star income stock portfolio over the past month. You and I sit down every second day, it seems, and have a good chat about Spark. The business continues to face headwinds, and this week announced a 4% downgrade to its financial year 25 earnings and a reduction in its dividend. But interestingly, the share price didn't react too badly. Why was this, Kien?
Yeah, very interesting with Spark, Tim, and we've certainly talked about it quite a lot. The share price has been declining over the last 2 months on exactly these concerns. You've got the New Zealand market technically in a recession, while Spark has been spending big on its data centers, and the market was expecting a downgrade, and news that management plan to divest non-core assets and also reduce their capital expenditure was somewhat of a relief in a way, Tim. In addition, that dividend guidance was revised to around 25 cents per share, down from 27 cents per share. And this was better than expected, Tim.
Yeah, and these figures have yet to be updated in Stock Doctor, but this update should help normalise its payout ratio and improve the free cash flow metrics under Golden Rule 3, Kien. And despite these headwinds, Spark remains a high-quality telco with a dominant market share in New Zealand, much like Telstra here in Australia. So from an income perspective, not that it's without its risks at the moment, especially based on the struggling New Zealand economy, but it may represent a bit of an opportunity right now for those brave enough to take it on. And moving towards resources, Kien, over the week, gold miner Capricorn Metals announced a capital raising of $200 million, roughly about 8 to 9% of its market cap, to fund 2 key projects. Firstly, expanding the Karlawinda gold project and developing the Mount Gibson gold project. How will this impact the return on invested capital of the business, Kien, under Golden Rule 3?
The Karlawinda expansion, it's expected to increase annual gold output by around 30% once that ramps up. Meanwhile, Mount Gibson, that's a growth-focused asset and could contribute to the doubling of its total production over the longer term, Tim. And this capital raise may dilute the return on invested capital in the short term, but remember, we've got strong gold prices as well, and that could mask this impact as indicated by the strong return on invested capital metrics under Golden Rule 3. And Tim, looking at the corporate calendar for the week ahead, It's going to be quite a busy week with a few trading updates, especially with AGM season still on the radar. We've got star stocks, including Breville Group and Jumbo Interactive, expected to make announcements. We also anticipate results from Westpac, NAB, and also ANZ as the bank reporting season kicks off, Tim. And also accounting software business, Xero, they are expected to release their interim results next week. So we'll be watching closely out for that one.
We sure will be. And now to Under the Microscope, Kien. And this week in Under the Microscope, we're taking a closer look at Aussie icon Woolies. The stock has come under pressure after downgrading its earnings guidance by around 8% for this year. So, Kien, what drove this downgrade for Woolies?
Yeah, Tim, there were a few factors here. Firstly, you had the regulatory and also political pressure on the major supermarkets around price gouging and also misleading promotions, forcing Woolworths to lower their prices in reality. And in addition, you had consumers, they were turning towards home branded products, which were cheaper, but had lower margins as well. In fact, the average price of the goods that they had for sale fell by about 0.3% in the September quarter. And this was in stark contrast to Coles, who reported a 1.5% price uplift over the same period.
Yes, it's something we certainly can all relate to, Kien. But I can't help think that in some aspect, Woolworths is intentionally trying to reduce prices to recover some of its market share lost to Coles over the past year, and arguably set up a lower benchmark for the incoming CEO, Amanda Bardwell. The important question for our income investors is, how will this impact dividends under Golden Rule 3, Kien?
Yeah, there's certainly margins are coming under pressure here, Tim, but Woolworths, they are paying dividends based on a percentage of their profits. So it may lead to a slight downward revisions to that dividend forecast, but the supermarket, they tend to have stable underlying earnings. So we don't think there will be a significant change here, Tim. In addition, you've got the payout ratio. It doesn't appear overly stretched by any means, while free cash flow is expected to improve this year and also support that dividend.
Yeah, it's a bit of a staple, isn't it, in most income portfolios, together with the banks and Telstra and Wesfarmers and a few others. Woolworths seems to be that rock solid income stock, not without volatility because of its tight margins and its competitive pressures, but it's a bit of a usual name that you see in most income portfolios. And given the recent update, Kien, we are waiting to see how the 3 months earnings revisions under Golden Rule 3 will change. I can't help but view the falling share price again as an opportunity for income investors in a high quality and stable business with the market share of around 37%, so a real market leader. And the gross dividend yield of 5% appears to be the highest it's been since 2016. And now, question of the week, Kien. And on the back of AGM season, we've seen some changes to the analyst price targets under Golden Rule 5 and 4. So an interesting question this week is, what is the consensus price target and how can our members use it to help make investment decisions?
Yeah, Tim, the consensus price target, that's really the median or the average of the consensus analyst estimates on where the price is likely to be in about 12 months and is used by most investors as a valuation gauge. However, as we've seen during the AGM season, consensus price targets often change. And our research does suggest that investing in undervalued stocks based on consensus price targets alone may not be very effective, Tim. And this is because share price targets tend to follow the share price rather than predict where it will eventually land. And the reason for this is because analysts don't really want to stick their neck out in case something goes wrong.
Yeah, and that's why, Kien, it's a secondary golden rule, isn't it? It's not part of our golden rules 1, 2, and 3 that determine star stock selection. It's one of our secondary rules that can obviously play an important role in stock selection, but is certainly secondary. And price targets are often very subjective, Kien. It's extremely difficult to put a value on a company if you don't know with certainty what the cash flows are going to be in the future. In addition, investors should not be afraid to pay a premium for quality businesses. That's a really important aspect. That's why value comes second to us, and quality comes first. So sometimes you've got to be prepared to pay a high premium, because over time, as we've seen with stocks like Pro Medicus and Hub24, for example, the price target will eventually follow the share price.
Yeah, that's right, Tim. And although consensus price targets are not useful in an absolute sense, though, assessing that trend in the price target can help improve your investment outcomes. And you can see this trend in the price target compared to the share price under Golden Rule 4 by selecting the price target button at the top and displaying that chart over, say, a 5-year time frame. So you can really see the history here. And this will give you a sense on whether that stock usually trades at a discount or premium to its share price over time.
On this chart, you'll notice that the share price target has a positive correlation to the share price itself. In other words, assessing the change in the price target is more useful than focusing on the premium or discount to the consensus price target. You'll also see that the 3-month change to consensus price target under Golden Rule 5. But be mindful that the number of covering analysts is important. We always like to see more than 3, so that we can have that real confidence around the reliability of those price targets. So I hope all of that is useful, because it is a nice little rule of thumb there within our 9 Golden Rule framework. So Kien, that's all we've got for today. Really good content. So thank you to you and your team for pulling it together for our members.
Pleasure, Tim. And I can't believe, as you said, November's here, and this week coming up, that's the bank reporting season. So we'll be carefully reviewing the banks, which have rallied quite strongly over the last couple of months.
Yeah, got to see what happens, don't we? Now it's a really important time of year, but there's still so much going on around the world, so many influences on equity markets. Can they keep roaring ahead? I mean, for the year to date, most markets are up between 20% and 35% roughly. Now that's a huge year with so much what you'd think situations going on that leads to a probability of a correction. The correction hasn't occurred, but can equity markets keep roaring ahead the way they have? Not sure. Just got to see what happens. Time will tell. But on that subject, we've started to remove our hedge from our funds, our Aussie equity funds, income growth, and the US, on the back of things just haven't played out the way we thought they would in regard to the probability of correction over the next 12 months. But because we believe there still is a reasonable probability, we're tactically and slowly unwinding the hedge. We've let a third go so far, and we intend to unwind the rest of it over the next 5 months. Now, if there is a correction, we'll unwind it really quickly. If there isn't a correction, it'll be a slow unwind, as I said, over the next 5 months. So we're doing that. We've originally put it on because we were really mindful of looking after investor funds and fiduciary responsibility. Because of the probability of correction, we've obviously missed out on what's happened over the last 12 months. And going forward, because of all of that, I'll certainly be blocking out any noise because the markets are super, super unpredictable, but there still is a probability of correction, so it will be slow. So that's have a read of my quarterly message too, where I really cover off on that in more detail. If you're interested, those that do have a hedge in place, then perhaps you want to take heed to what I've just said and perhaps follow what we're doing now as well. Don't forget our referral programs are in place. We grow because of your word of mouth. So please tell family and friends. And our platinum membership also that we launched a couple of months ago, off to a really good solid start with members coming on board. Positions are still available there. So if you're interested in that, just give us a call. So yeah, that's it for another week of taking stock. Can't wait to see you all again next week. For those that are having a punt on Melbourne Cup next week, all the best. Take care. Have a happy, healthy, and prosperous week.